Hello and welcome to the Monday Futures Market Outlook for May 6, 2013. This is Patrick Sresna. As always, we start off with a chart of the U.S. dollar index futures, and the U.S. dollar has consolidated down toward that 81.50 a focal point numerous times to find support at this juncture. That support line should continue to hold unless the euro has some sort of a substantial rally higher. We do believe that that's unlikely, and so that support has a very good probability of holding. Eventually, we would need a turnaround in the euro and a substantial devaluation of the euro to break the U.S. dollar higher, but that continues to be our thesis, and we continue to look for U.S. dollar that could be as high as the 85 level over the upcoming months. Next year, I want to take a look at the Euro FX futures, and we have a substantial overhead resistance of the 132.50 area. And while the euro has been relatively strong from its Cyprus low back in March, we do believe that the euro is vulnerable to turning lower, but it doesn't necessarily mean it's imminent. We could still see another stab at the upside, including a sideways consolidation for weeks. But we do believe that the best probability here is that the euro does have a breakdown move, and when we finally see a break below 130 is one that will really open up the window for another leg lower. Next year, I want to take a look at the 30-year Treasury bonds, and the jobs numbers really did give these a turn to the downside off of overhead resistance. This will be the first throwback that we're going to see in the bonds. That doesn't necessarily equate to a trend reversal yet. We want to see how the follow-through really develops, but we could find supports very easily in the 145, 146 area below another handle lower. But really at this stage, when we'll see how that behaves there, and then whether or not it can roll back up and maintain an uptrend, or whether or not this reversal here took the wind out of the sails. Next year, I want to take a look at copper futures, and copper really has hit a short-term low with that double bottom retest and reversal back up. And while it has hit a short-term low, it doesn't imminently equate to necessarily a new uptrend coming on the other side. We've already achieved the first upside target at the 135, where the lows came in 2012 in the summer. And really at this stage, this should be a point of overhead resistance. Now, there is a chance we could see a move even as high as the 350 area, which it could certainly allow some short-term traders to give a little bit of upside potential, but we're skeptical at this point of a new uptrend until we see the price action develop. Next year, I want to take a look at crude oil, and crude, with the way that the price action has pushed back up to 96, has really continued to demonstrate far more of a range-bound sideways market than a downtrend or an uptrend, and therefore we want to just simply respect the fact that there's substantial overhead resistance coming up in the next few dollars higher, and it's likely that crude oil will have to test that zone to prove that it can break above it, and so we want to stay very neutral. Crude oil, respecting that it's very close to overhead resistance levels in the next few dollars higher. Next year, I want to take a look at gold futures, and gold has worked its way back up to the 1470 level off that trading low. I mean, we have seen that capitulation low in there, but it doesn't mean it won't be retested or at some stage leave a further consolidation in gold. While we do and have been looking for opportunities to buy gold, we at this stage will be looking to see when the next dip occurs on gold, whether or not it breaks to a lower low. If we really start to see good consolidation off of these levels, we'll be looking for the bullish turnaround. Finally, when we take a look at the S&P 500, that jobs number really gave the S&P a real push above that 1590 level, which was sort of our overhead target for a potential double top. With this breakout on the upside, we're seeing a short squeeze on that is squeezing out any ambitious shorts. At this stage, there is room for us to see even a 1625 or even 1645 on the upside for these different targets, but we are anticipating the smart money to be selling this rally. And so let's watch to see whether or not some of these upside targets will be hit, but also whether or not we see high volume distribution going into that strength. And so we'll watch to see whether or not that occurs. At this point, there is no imminent drop. We were looking for the chance that a double top would have created the topping formation to allow a correction to occur. At this stage, it's clear that it's going to happen off of a higher level, and so we're going to remain observant of where the overhead resistance will be in the upcoming week. Just to review our key intermarket observations, we remain relatively optimistic the U.S. dollar, as we believe the Eurozone will have to become more accommodative and force the euro lower, which will continue to allow the U.S. dollar to strengthen. We do believe that the risk-reward of commodities is very neutral at this stage. While it's been in a very clear downtrend, a lot of the downside risk has already been priced into those commodities, but we don't see an imminent uptrend underway, so we're going to just remain very neutral on our position there. We do believe that there's a good chance that bonds have begun a new uptrend, particularly the 10-year, which is already broken out. We do have a little short-term throwback, and that throwback, if it finds support in the next week, could actually be a good buy on dip on those bonds that could remain in trend for even a few more months moving forward. We're changing our outlook on U.S. stocks from a risk-reward perspective to now very poor. That doesn't mean that the stock market won't go higher here in the next few days, but simply the fact that remaining long the U.S. market is becoming a worse and worse proposition every level higher and higher that the S&P goes. Inevitably, at some point, market corrections are always a certainty. And so the higher the market goes, the greater the probability that we're closer to the top. And so at this point, we're recognizing that this market rally is getting very long in the tooth. That was your Monday Futures Market Outlook. Thank you for joining me.